For those institutions that invest in REITs, 90% of them do that out of their real estate allocation. And again, I think this comes back to the growing view that public and private market exposure within real estate portfolios can be very complementary.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. I'm speaking today with Doug Weill, founder and co-managing partner of Hodes Weill and Associates, a leading global capital advisory firm. Doug is going to share the key findings of the 12th Annual Institutional Real Estate Allocations Monitor, which Hodes Weill publishes in conjunction with Cornell University's Baker Program in Real Estate. Doug, welcome back to the podcast.
Thank you, Sarah.
So for the second year in a row, we saw institutions hold target allocations to real estate flat in 2024. What are the factors behind that? And is there likely to be any reversal of the trend in 2025?
Yes. Today, institutions allocate on average about 10.8% of their portfolio to real estate. And that has been flat for the past couple of years. That follows the period of time of almost 10 years when allocations were up about 20%. So we are clearly seeing a moderation in the growth in portfolios. And also importantly, institutions expect that on average, they'll lower their target allocations by 10 basis points over the next 12 months. Now that's directional. It could go up, down, or stay flat. But I think it is meaningful that institutions, for the first time that we've seen, are actually indicating they may lower their targets. I would point out, though, that from the standpoint of the industry and overall allocations, you need to look at actual allocations versus target allocations. And what we're seeing today in portfolios is that they've shifted from over-allocated on average to under-allocated, and today are about 60 basis points under-allocated. So institutions have capital available to invest. It really comes down to market sentiment and whether they're ready to put money to work.
Would you describe that investor sentiment toward real estate more broadly? And what signals do you think investors are likely to be paying attention to before committing to the sector going forward?
We measure market sentiment on a scale of 1 to 10. And today, on average, sentiment is somewhere between 6 and 7 points. So we view that as moderately optimistic. I think what we're hearing from institutions, though, is that at least for the past couple of years, they've been cautious about entering the market, concerned about price transparency, concerned about where the bottom may be and when it will arrive. But over the past really 4 or 5 months, we've seen some signals that are bringing institutions back into the fold. Namely, some of the big alternative managers, including the likes of Blackstone, have indicated that they believe we're at a market bottom and it's time to invest. And they followed that with some very notable transactions, private market transactions, take private transactions of REIT. And that has created both price transparency in terms of trading metrics, valuation metrics, but also just the market sentiment seems to have picked up. If you look at fundraising for private funds in 24, it's another down year. But I'd say the back half of the year, we've seen a lot more activity. And the expectation is as we turn into 25, we'll see a meaningful pickup in capital allocations to private funds, both closed-end and open-end potentially.
When it comes to institutional allocations to REITs, the signs look quite positive according to the latest survey. Can you highlight the shifts that you're seeing there?
Sure. We noted in our survey that about 39% of institutions actively allocated capital to REITs in 2023. We ran the survey from their early summer through the fall of 24. And that was up meaningfully from the prior year. So the prior year was about 36% and went to 39%. And notably, sovereign wealth funds were meaningfully more active. I think this is an ongoing trend where institutions are increasingly active out of their real estate allocations in REITs, and REITs are increasingly a complement to private market investments.
What are some of the main reasons institutions are allocating to REITs today? And you mentioned sovereign wealth funds. Are there other types of institutions that are allocating to REITs more actively than others?
Yes, there are absolutely. So we would say, or at least based on the survey, that liquidity is the primary reason or objective. About 67% of institutions indicated that liquidity is one of the reasons why they invest in REITs. And that was up from about 46% the prior year. We would attribute this in part to the illiquidity we've seen in private market portfolios, in particular the open-end funds where there have been exit queues and redemptions have not really been completely satisfied. And so the increase in importance of liquidity is, to us, not surprising. What we also noted is that institutions were more interested in using REITs on an opportunistic basis or for special situations. You asked, there are two institutions in particular, New Mexico State Investments and TRS of Texas, and they each announced tactical allocations to REITs to take advantage of the price discrepancy between the public markets and the private markets, and have been actively deploying capital. So those are two good examples of large institutions that tactically made an allocation to REITs in this kind of market dynamic.
Doug, can you explain the significance of whether institutions allocate to REITs via their real estate allocation or public equity allocation, and what the main trends you're seeing there?
So there was a lot of discussion when REITs joined the various indices over the past 10 or 15 years that REITs would end up in public equity portfolios. But what we found in our survey is that 90% of institutions invest in REITs out of their real estate allocation. And I should say, for those institutions that invest in REITs, 90% of them do that out of their real estate allocation. And again, I think this comes back to the growing view that public and private market exposure within real estate portfolios can be very complementary.
Great. And are there any differences in how US investors view REITs versus non-US investors? For instance, big European investors like APG, PGGM, Bauer Invest, and Norges put close to 50% of their real estate allocations into REITs. Do you see big US institutions ever doing that?
I think so. I think there is a difference between the larger institutions, pensions, for example, versus, say, endowments and foundations in terms of how active they are in allocating to REITs. I would say that in general, US institutions approach real estate with a higher return objective than European institutions. And I think that is a contributing factor because many institutions look at REITs as a proxy or an alternative to core investing or a way to get exposure to core investments. And so I think that's a bit of the backdrop as well. But again, we're noting that the allocation to REITs seems to be growing, and that includes from US institutions.
Now, there's certain property sectors that you expect institutional investors to be most focused on in 2025 across the broader CRE market and REITs.
I think a couple of comments that I would make. One is that there is this prevailing view that the next couple of years will be good, quote unquote, vintage years to deploy capital into real estate because of the dislocation, if not distress, that we're seeing as real estate has repriced. That's more of a view on an entry point. I think also institutions are focused on strategies and sectors that have favorable tailwinds in terms of operating fundamentals. So we see continued demand and interest for industrial strategies, a range of residential strategies from multifamily rentals, both higher end of the market down through workforce to affordable, and also single family rentals, more on the purpose built than the scattered at the moment. But there's increasing interest from institutions in having an allocation to single family rentals. I'd say also notable is that there's growing interest in retail strategies again, in particular grocer anchor and also strip or essential retail. These are assets that have in the United States performed really well over the past cycle, and they continue to trade at yields or cap rates in excess of cost of debt, so you could actually borrow accretively. The fundamentals have been really strong. And so for the first time in quite some time, we're seeing more interest in retail strategies. I thought it was notable to come back to Blackstone again. Their take private of ROIC was a good example of an institution that is, of course, regarded but making a play in retail.
Doug, we've covered lots of topics, but any final thoughts on what you feel the latest survey is pointing to?
I would say that over the next couple of years, we think real estate will benefit from strong liquidity and capital flows from institutions. It is clear that real estate is competing with other allocations, private credit and infrastructure in particular. But real estate has performed reasonably well over this past cycle, despite the reset in valuations. And as institutions are seeing their public equity allocations and other asset allocations perform really well, extraordinarily well, and real estate through 6 to 7 quarters of write-downs, institutions are, as I mentioned at the beginning of our discussion, institutions are now underallocated on average. And so that, coupled with growing sentiment, we think will drive more allocations to the asset class. And real estate is a capital intensive industry. And so that's good news for everybody. I think we should all watch transaction volumes, how REIT shares trade, what the largest investors are saying, including some of the public alternative managers on their earnings calls. It's a great way to keep a read on market sentiment. But again, I think the next couple of years, we expect that capital flows will really pick up. And that's after 2+ years of really a down cycle in terms of allocations. So we're hopeful in that respect.
Great. Doug, thank you so much for your time today.
Of course. Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.